Not a whole lot in the overnight hours, gotta say. And perhaps that's not necessarily a bad thing. So, like we do every morning, we want to start with uh, what happened around the world. Generally, I use finance juice for that. There are times where, uh, I'll kind of look around and try different spots, but I really haven't found anything better than this when it comes to just kind of asking that question, what happened? There was a place, if you and it's useful for more than this, it's called Koifen. You can also use bar charts or NIO. There's a million places out there. I just, this one seems to be my go-to. We do have a lot of things on the list, but really not a lot of times. So 8:30 and 10 is the big one, or 8:30, 9:15, and then 10. And I'm using different numbers than what you see here on the screen because this is recognizing what time zone I live in, and it needs to recognize, market time. So right now, one of the biggest risks we have is the railroad risk. If that doesn't get resolved, I've seen something from the White House. They were talking about trying to find alternatives, but I mean, it's unrealistic. So that's one of the major risks. The White House also yesterday basically put in a floor and said that they would start buying at around $80 in the in crude. And they've been releasing their strategic petroleum supplies, and this would be their way to kind of refill the coffers, so to speak. There's a tropical storm, Fiona, that is not yet in the Gulf, I believe, but it's certainly something to keep your eye on. If we do end up getting a hurricane in the Gulf, that would send energy up significantly. So that pretty much was the overnight. One of the main things we're looking for is something that has lasting ramifications. And usually the example that I give is when that ship got stuck in the canal. That became like a big blown out deal. It lasted for a while. And that's one example, but it's a really good one. So when you go over there in the mornings, you're looking for the big picture. Don't get stuck in the weeds reading a bunch of minute details. If there was a really strong sector over in Asia that bled into Europe that is likely to bleed into ours, that's worth looking at. A strong up sector or a really, really weak down sector, that'll bleed over. And then any kind of news that like a ship stuck in that canal that can really disrupt things for a long period of time. We're looking for the big picture news and then just move on, right? Get your list of the day, the schedules, the time frames. Today we have additional auctions. These are always really important to what I got going on in a day-to-day basis. I know they don't really get a lot of attention out there in the rest of the market, but to me, they're really important. I've caught so many midday reversals just because I was prepped and ready to go. because I knew that there was an auction at 11:30, or that I knew that there could likely not be a lunch range because we had auctions at 11 o'clock. There are times where we'll get a 1 o'clock auction, and that greatly affects 0-day trades. Can't tell you how many times I got into a 0-day trade around 12:30 or so, thinking, oh yeah, we're in the later part of the day, everything is fine. And then around 1 o'clock, it would all just start unraveling and go to hell, and figured out that it was these additional auctions. So it's worth paying attention to when they are and which ones, right? When it comes to these different auctions, some of them have more weight than others. The 3-month, the 2-year, the 10-year tips today, 30-year. So if you're kind of new into that, just focus on, hey, we have them today. They're at this time. Okay, like we do every morning, I want to start with volume. Volume looks a little light today, but to put it in perspective, right? If we were to go back and look when it wasn't CPI and it wasn't PPI, we would find, the low 90s is not bad. We had high 90s here, mid 90s here. So we're sitting at around 92. It's not that bad. If we get below 50, that would be a number to kind of pay attention to. Like it's 7:30 in the morning, we should be above 50. So if we are below that, we'd want to know, what's the catalyst that everybody's waiting on? Why is it so light? If we come in and it's sitting at around 220, 250, right where that line is at 7:30 in the morning, we'd want to be a little concerned. What's driving the volume so early in the morning? What's going on out there? Otherwise, when we come in and we look at this, we see that it's low to mid 90s. It's good. Just turn it off. Just get it out of the way, because you don't need it at that point. It's done its job. No reason to donate the real estate. All right, get rid of it. We are inside day right now, and it's a very compressed, very muted day so far. The market is still a little bit butthurt, I guess is a nice way to say it. So many institutions were off sides. They were caught unawares. So to kind of back up a moment, let's come over here to the good old web. This is that CME FedWatch tool. We're looking at the September 21st probabilities of a basis point rate hike, FOMC. And what we want to look at here is, what's the current rate? Let's just get that out of the way. I know there's two numbers, and that's because we kind of just split the mid. To make all of this less complicated, just pick one. And I don't care which one you pick, and it doesn't matter. Pick the lower one, pick the higher one, just pick a number. Okay, so then just say that. Current rate 225. What they're asking here is, how likely is it that on September 21st, we get a rate hike that pushes us from 225 to 300? 74% chance that that's going to happen. If we ask, what's the distance between 300 and 225, it's a 75 basis point rate hike. So this is 75 BPS, basis points. $225 to $325, that would be 100 basis points. What's the probability that we get a 100 basis point rate hike for September 21? 26% chance. All right, now if you've seen this before, if you get it, hey, great, you got it. What was it an hour ago? What was it last week? What was it yesterday? Are they pricing this in Are they not pricing this in? Are things drastically moving? To get those kind of answers, you got to look farther. You got to look down lower. So for the 300 to 325, right now, we have a 74% chance of that happening. Yesterday, it was a 75% chance of that happening. And 1 week ago, it was at an 87% chance of that happening. And take it back a little more. A month ago, it was a 39% chance. So there's been some drastic changes in this probability over the last week or so. We want to see that number start to slow down. That'll kind of fill us in that they're done repricing things. Now, this is just one contract or one date. So let's go to the November 2. On a day-to-day basis, what I'm looking for when I come in here is the distance between yesterday's number and today's number. These two columns right here. I don't need these two back ones because I look at this every day. I already remember what it was Monday. I remember what it was Friday. If you haven't been in there before, you're going to need these just to kind of give you an idea of, hey, where were we a week ago or 2 weeks ago, whatever. One week ago, there was an 84% chance. Now it's a 25% chance. That's a radical repricing. This was at 3%, and it's now nearly at 60%. That is a radical repricing. So when we ask, are they done? Are we done falling in the market? Are they going to continue to push the market down? Are they pricing in these, kicking the can on the Fed pivot down the road? Yeah, they're getting kind of close because these numbers between yesterday and today are not as wide as they were. And when you come in and they're almost unchanged completely between yesterday and today, then you'll know that they're done. They're nearly done, probably not quite done. And don't just look at one date. Make sure, check December, make sure they're not moving those December contracts out or the December probabilities. Check February. Anything beyond February, these grayed ones, these are hypothetical, quote, they think it might be on that date kind of thing. So just stick with the ones that aren't grayed out. All right, so now you know how to use this tool a little bit better. And they've got, users guides and methodologies, you name it. But when we're trying to figure out, are they done repricing things yet? Just look at what it is now. Look at what it was yesterday and see if the numbers are really far apart or not. If they're not very far apart, then there's not a lot of changes going on. That means they're about done. Any new information, say like, I don't know, retail numbers that come out today. Any information like that can make them want to reshape these numbers, these probabilities. So after the event happens, take a look at this tool, see if they're starting to price in changing probabilities. Simple enough, right? So when we come back to this, leading it all into a big circle, are we done? This big drop, part of it was that repricing, right? If they're done, then what? Well, we talk about a market under influence, and that's what drove us to the downside to begin with. If they're done influencing it, then it can basically, they just take their hands off the wheel and let it go where it normally would go. And a market normally will buoy. It'll go up just instinctively, naturally. It's what a market does. It goes up unless external or outside forces are pushing it down. So once they take their hands off the wheel and this starts to stabilize, the expectation is that we'll start to grind back up. barring any new news or circumstances or anything else that's going to come in and make them readjust those probabilities again. There's always that phrase, oh, it's priced in, right? Earnings is priced in. The new AMD chip priced in. The news of an Apple phone is priced in, it's priced in, it's priced in. With that Fed fund tool, out of all the different things that you can't see getting priced in, that's one that you can. So use it. All right, the likelihood that we stay inside this range is small. We're going to eventually leave it. That's the market promise, and it is guaranteed. We will leave this range eventually. The question is, are we going to leave it today? I would bet that the answer to that is yes. If you go out to the daily chart and you look at how often the S&P closed one day inside of a previous day, yeah, you get that a lot. But how many times does the S&P actually give you an IX10, which is multiple inside days, when the first day is a really compressed day? That's the key. If we're inside day and we're inside of something like this big red candle, that doesn't mean anything to anybody. Like, who cares? Getting inside day in that big old monster, that holds no weight, no value. It's meaningless for any kind of play or strategy or setup. But being inside day within this tiny little candle here, that primes us up for an IX10. Inside day breakout. The market is just like a living, breathing thing in nature. And in nature, you don't compress it and contain it. You have to let it out. That's why there are spillways at dams. You have to let the energy out, or it'll just build and build and build and build until it pops, explodes, breaks. Now, there's no direction promised here, but the longer we stay compressed inside of that blue candle, the more energy it's building up. So when the move does come, it's likely to come with a lot of energy behind it. Now, again, this isn't promising you which direction it's going to go. You can use other tools for that. But it's very unlikely that we're going to get another day inside of this day. It is a big candle, which means we can measure that big candle. Our upside moves, which really aren't going to help us out that much. Our downside moves, which would give us some really good levels to focus on. If you did that same thing with Jackson Hole, that big event on Jackson Hole, on the ES, it doesn't line up as good. Do that on the SPX, and that drive to the downside stopped right at the 100 line. And it paused at the 50%, like it was really thinking about turning around there. And then it just couldn't stick and dumped through. $39.80, $39.30. It's a 50-point range. Pre-COVID, a 50-point range would have been something we'd all be cheering about. It'd be so amazing to have a 50-point move or a 50-point range to play in, or even just a 50-point expectation pre-COVID. Now 50 points is like, what? That's all you're going to give me is 50 points? We get the weekly pivot point over our head. If we break through this retrace, let's see which one, 618 retrace, we're likely going to hit that weekly pivot point. The pivot point is really close to the ADR half. So it's the 4011 cog line or the ADR half, either one. That's 3 bundled pivot points all wrapped up nice and tight and close together. I would consider that a significant level of resistance that we're going to have to fight through. And if you look back, right, just look left, we can see that it was a significant level on that day where everything got really wild. It wasn't necessarily a resistance, but it was most definitely an area where price responded and reacted and magnetized like a cog line, which is COG, center of gravity, 4011. Imagine that. We have a 21-day ADR of 2%, which would be this yellow line way up here, 4050. We could move to 4050 and it wouldn't even be considered extreme. It wouldn't be an outsized move. It wouldn't even be an outlier. Getting a move to 4050 would be as common as somebody getting up and going into the kitchen to get a drink. No shock and awe, no excitement, no extreme POV to that at all. So if things really start to get wild today, like we do before, measure the distance between the ADR half and the ADR full, and then plot that distance as your next level up. There's no market maker move tag up here, so we don't need to worry about that. And the previous week's high is at 4077. That would give us an inside week breakout if we happen to get up that far and then break through the top. It is more likely that we're going to go up rather than down, unless the news is bad, right? We got a lot of econ on deck today. It's not really anticipated to be the event. I believe OPEX has probably got more weight on the market conscience at the moment than the retail numbers. But I mean, you know, we'll see. So if things were to go to the downside, 39.31 is the ADR half, 39.11 is the cog line, 38.91 is the ADR full, and then we are in the previous week's low. So if we break below 38.83, then we're inside a week breakout to the downside. And again, just getting to that yellow line, 38.91, that would not be an extreme move. It would just be another day. If we do get that far, you're going to want to plot out the next level. Take the distance between the ADR half and the ADR full. And you can get out a calculator if you want to and like really nerd out and make it precise, but you don't need to. Just measure that distance and then plot that distance down. And this becomes the next distance. All right, we're looking at a 10-day, 30-minute volume profile. There's always something with that ADR or that OBS. Thank you. I will get the video uploaded from Zoom onto the YouTube. You know, that thing wouldn't even let me use it today. I had to completely reset the YouTube account on the OBS to get it to even connect. I love the new OBS layout, but that thing just like randomly resets itself back to default settings. I think I'm going to go back to the old one. Thank you. $10-day, 30-minute volume profile and TPO. In blue, that's the TPO, and in green is the volume profile. I know they look really similar. but the one in blue is time, price, opportunity, TPO, and the one in green is volume profile. When we use phrases, the phrases make it easier to understand. In green, it's volume by price. In blue, it's volume by time. Simple enough, right? When we're at the bottom of the box, we expect to go to the top of the box. When we're at the top, we expect to go to the bottom. If we get out of the box, we expect to get back into the box. We're really close to the point of control. We are tangled up into all of this massive volume, and there is nothing here of any value to offer any insight. We would have to get completely outside of the box and get all the way up towards that previous week's high before we get into a shallow area. Something that shallow, we would likely move through it really fast. But down here, we've just got a lot of trash and there's no insight here at all. And it's not likely to change anytime soon. So right now, this is worthless. The only good thing out of saying that is we know that it's worthless and we just move on from there. A lot of times an indicator isn't giving you a signal, it's just giving you noise. The trick is to figure out what's the difference between the noise and the signal. And then we just don't waste our time on an indicator until it's giving a signal. Right now, this is worthless. It's just noise. We have our VPOC from 9/13. That's that big drop day with the point of control at 40.04. The value area low from yesterday could be carried forward. I've mentioned this before. If you go and learn and study volume profiles, they'll tell you that you can carry yesterday's levels forward. I don't do that, mainly because I've got enough pivots. But I would rather carry forward the low of yesterday than the value area low of yesterday. And what you'll find is most of the time they're very, very close together anyways. I do like to carry forward the point of control, but only until it got whacked. And if you look at last night, it was the spot that price kept stopping at until finally it broke through it. Well, we've crossed through it. It has no value now. But the untouched point of control from the other day, that's still over our head. That's still one that we would want to focus on. All right. So we got a gentle sell-off in gold. And it looks like it's trying to stabilize a little bit. Not yet. Still riding underneath that VWAP. And the 30-year bonds has been a consistent, persistent move to the downside. Very beautiful price action underneath that VWAP. Now, that's a textbook example of an algorithm using a VWAP, right? Like 10 or 20 years ago, if a client went to the firm and said, I want to get in, use some silly numbers. I want $10 million of X. They'd say, well, okay, well, we guarantee you $10 million of X at average price. How do you get to average price? VWAP. So when they type in the program, the little algo does its job. Every time price gets around that, it buys or it sells, because there's clients that they've promised will get you average price. There you go. That's exactly what it looks like. So price comes up, hits the VWAP, the algorithm kicks in, does its job, and it's unloading X amount of contracts When it gets too far away from VWAP, the algorithm turns itself off, lets price drive around, do what it does, random walk. Price comes back up to the VWAP, it triggers again, activates that selling mechanic, sells it back down again, giving the client what they asked for. They want X amount in or they want X amount out, and they've made them the promise. Yeah, sure, we'll get you average price. So when we see VWAP and it's just getting crisscrossed and chopped up and ripped apart, or you see these crazy strategies that are using VWAP for goodness knows what, keep in mind what it's being used for, right? There's a difference between what it was designed to do and what they're actually using it for nowadays. Well, there you go. There's a perfect example of using VWAP to liquidate a position or to at least reduce a position. And if you look at Bitcoin, you can't tell me if it's buyers or sellers from looking at this, and it very likely could be both. So when we talk about it's just noise, I mean, that's a perfect example. It's just noise. Leave it alone. Wait till it gives you a good clean signal of something. And of course, the argument is you would need this much, what is that, 5 hours to be able to look at it and say, oh, look at that. They're absolutely running a sell program. You wouldn't have caught it in the first 20 minutes, right? You would need enough of it to be able to validate your statement. I was asleep, so I didn't get involved in it. Now all we have to do is wait for it to end, as it won't go on forever. And that would be your opportunity. So if you missed the game, don't try to play it now. It's been going on long enough that it's very likely going to stop at any moment. Plus the bonds open and the dollar opens at 8 and 8.20. So don't try to play it at this point. Just look for it to end and then play it. The VIX calmed down in the overnight. Not a lot of excitement, which makes perfect sense because there's not much going on. We are looking at the VIX futures. I tended to look at those more often than the VIX. The Octobers are sitting at 27.35. The Novembers are at 27.65, which is round up for easy numbers. And then the Decembers are at 66. There's almost no daylight there between the Novembers and the Decembers. We're still in contango, but only by 3 pennies. So if those Novembers start to bid up just a little bit more, they're going to be more expensive than the Decembers, and that's going to start putting us into backwardation. Keep your eye on those volatilities, whichever volatility thing you want, UVXY, VIX, whatever. If you're on a broker that doesn't offer you VIX futures, you can use VIX with numbers. So VIX 9, that would be your 9-day. The VIX itself is 1 month, but then you can type in VIX 3, you'll get a 3-month. Then there's a 6-month, and then there's a year. So you can look at every one of those and see their pricing model. And what you want to see is the shorter the duration, the lower the price. The higher the duration, the higher the price. That's contango. It's normal. What you're looking for is backwardation. You're looking for the front end to get higher than the back end. All right, we're looking at skew. We're not really out of whack here. Nothing out of place. It's fine. It's a little low, but it's fine. Don't have it in my head anymore. Now, well, we were going to look at the 210, but I don't have the chart where I normally would have it. I swapped computers when I got this one back from the shop and didn't get everything loaded yet, it seems. Speaking of volatility, we were looking at bonds a little bit ago. This is the move index. This is like volatility for bonds. So we're not really out of place. It's kind of going down, right? So maintaining this range, nothing standing out. That's all we're really looking for, something extreme. We don't see anything extreme, it's fine, move on, no big deal. Now, I've often heard this called the most important ratio chart, and I don't necessarily agree with that, but it kind of imparts the importance of it. Consumer discretionary versus consumer staples. Getting that move back up, even though we didn't get much of a move in the S&P yesterday. If we use different ETFs to look at growth versus value, IWF versus IWD, kind of get that same little leg up yesterday. So to put it into context, when this is going down, its value really should have left that on at a higher time frame. But I turned this thing where it's going to move with the market, right? Instead of being like an inverse one. So if tech is doing good, if consumer discretionary and finance is doing good, if the market's doing good, the S&P is going to rise. This is going to be pointing to the upside. When you start to get the divergence, this moving down, but the S&P still moving up, this is giving you the heads up that it's backwards, that the market's topping out, getting into a situation where growth versus value are rotating. So we got some divergence here. We got a higher low on the chart at the SPX, and we have a lower low in the growth versus value. It's really worth paying attention to. Stocks versus bonds. Nope, nothing there. And there's the 210 curve. The zero line stands out. It's that big yellow line. We are significantly below that. And if we look back in history and ask, well, where were we at these levels before? There's 2000. So we're sitting into those extremes. All right, so we got OPEX this week. Keep that in mind on your swing trades. The Fed is going to go into quiet mode in about it's coming up. I don't know how many days left, but we're gonna lose the Fed being out there chipping their teeth and rocking the market. It would not surprise me if we continue to see the president popping up. Likely some ECB. So the bigger picture, we want to see the bonds stabilize, quit moving around. Don't forget they got auctions today. We want the dollar stable, maybe kind of soft, a little weak, but no big moves. And we want that VIX to get back below at least, say, 25. On the VIX, watch for that inversion. Watch for us to slip into backwardation. All right, pre-market change percent. We're looking at the NASDAQ 100. The monsters of tech stands out really easy. It's those big boxes. The boxes are based on market cap. And other than Tesla being up a little bit, Meta's down 0.5%, Google 0.5%, Microsoft and Apple less so, but still down, and then Amazon. So pretty rough out there on the tech side. Semis are still getting beat. That rail thing is going to affect a lot of stuff. So chemicals, I know there was an article about anhydrous ammonia yesterday. There was also this morning, they were talking about Amtrak and passengers. So they're not, any long trip train rides are being shut down now. I live in Kansas, so it's a farming community. Farmers use ammonia all over the place constantly. This is going to affect prices of food. I mean, you name it, right? So it's a big deal. Even though there's no resolution or it hasn't started yet, we're already seeing the effects of it. So anything that is a major thing being moved in rail, keep your eye on. That could be chemicals. It could be, you name it, right? Go down the list. That's going to cause a significant divergence between, say, the S&P and the NASDAQ, right? Just because of the different companies that are in one index versus the other. Now, they don't offer me the S&P 100, right? I don't have that choice. So when I go to the S&P 500, what I usually do is just use the filter here and knock it down to around 100 names manually using market cap to help with that decision process, right? And it's not perfect, but having 115 is better than the 500 in total. Now here in this scanner, we can use the S&P 100. And we want to ask the question, just a very basic, simple one. How many names in the S&P 100 are up at least 0.5%? 5. So like everything out there is holding its breath. And one of those that are up this morning is railroads. So there's nothing really significant in the S&P 100 making big moves other than these very small list of names. Health, technology. Health was doing amazing yesterday. And we seem to be getting a little bit of follow through this morning. When I come in and I've got 60 names that are all up at least 0.5%, that's a pretty big deal. But there's, just like we looked at with the futures, they're flat, they're sideways, they're compressed. We're not seeing any signal yet of anything sector-wise starting to take off. So if we don't have that to lean on, the thing about backwardation in the VIX, backwardation first, it exists anywhere, right? Anywhere that you can put price and time together in a sentence, like a 210 yield curve, for an example, then it's usually anything in the front is cheap and anything far away is expensive, because things in the future are so unknown. There could be hurricanes, earthquakes, wars, death, destruction. You don't know what's going on in the future. And so the future is usually more expensive. When the front becomes expensive, that's saying that everybody is more concerned about their right now immediate situation than they are about the future. When you put that into context with the VIX, which is like, it's volatility in its purest form. What's volatility? It's the nerd word for movement. When you have implied volatility, it's the promise of movement. We just strip away all the fancy talk and put it into plain English. Implied volatility is a promise of movement. If the promise of movement is greater in the front right now, what's closest to us, than it is farther away, then it shows that the market is getting ready for a really big move right now. They're not scared of some future faraway thing that might possibly maybe happen. They're loading up right now because they're concerned that something immediately is threatening them. But anything with time and price can have a curve, right? And that's where you start getting into backwardation and contango. We brought up Trend Spider here. And these two lower columns are things that have weekly options. TrendSpider won't let me make a list of 600 names, so I had to break the list in half. I arbitrarily broke it in half. There's no rhyme or reason to where I broke it. The main thing is we just want to look at what is moving in the pre-market. We were on TradingView and we were looking at the S&P 100 and we looked at the NASDAQ 100, but there's some really great things to trade that don't fit into those two categories. TradingView doesn't really do a good job of letting us use whatever watch list we want. You basically got to use whatever they have or build scanners to give you what you're looking for off of like the entire universe of stocks out there. I might as well just come over here where I can use my own watch list. Airlines started popping up yesterday, by the way. Just seeing jets there reminded me. So on Thinkorswim, I've got a scanner that's looking for action. And it's a great heads up for flow before the S&P and NASDAQ start to make a move, or it helps me validate when we do see a move. Say the S&P breaks a range, starts heading to the upside. If my watch list of stocks suddenly just puffs up like a blown up balloon, I know that flow is going out across the board into a basket of stocks. And I keep it sorted by sector and industry. So when I see the balloon getting blown up, I can look at, well, what sectors are driving this S&P drive or NASDAQ or whatever it happens to be. We want it to be our risk on sectors: finance, technology, consumer discretionary. Yesterday, it was healthcare predominantly. There was some energy in there. Tech kept rotating out, but airlines popped up in there a few times yesterday. And first it was just one name, which makes sense. But then as the drive continued, it kind of opened up a couple more airline names. It's worth keeping an eye on that sector over the next few days. Could see a little bit of a rotation. So this morning, pot stocks are up. Bitcoin and retail. I mean, that's really it in a nutshell. Everything else is either flat or down. My metric starts at 0.5, a half of a percent. Now, these are like legacy, old school, been around forever kind of things. We want to look at things, make our own sector, make our own basket of stocks, right? Our own ETF. Basically, we just throw in names that fit into a particular sector or industry and not pay too much attention to what index they belong to. Is that, like, is it in the NASDAQ? Is it in the Dow? Is it in the S&P? So if we look at EV names, for an example, mostly down. And the ones that are up are more like battery or component, like Canoe. I mean, sure, Ride's in there, but no GM, Ford, Tesla, Lee, Neo, they're all down. When we put things into a broad brush and we say, well, finance or energy or technology, that's a really broad brush. We know energy is moving around, but what energy? Oil and drilling, production, solar, nuclear, coal. So the broad brush of just saying energy, well, energy, they're all down. WMB, Williams Companies. And I see Econ down there. But let's see. Dial it in a little closer. EV exploration, APA's up. That looks like it's giving it back though. Oil services. Champion. NOV. Otherwise, those are down. I could have swore I had one more energy in there. I will have to rebuild it. The same thing goes with the financials. I know when we were over on TradingView, I seen a couple of financial names that were moving around this morning. That's a broad brush. If we say financials, it could be insurance companies, credit cards, lending institutions. You really want to start breaking that into smaller pieces. I watch KRE through the day, which is regional banks. I keep my eye on the XLF kind of peripherally, but KRE to me is a lot more important than XLF. Nothing really hopping over there, but they're not beat down as bad as a lot of the other sectors this morning. This is one of our risk on sectors. If we're going to light up, we need finance or tech. And I mean, this doesn't exactly scream bullish yet, but it's certainly not beat down, say like energy was looking. And right now, for an example, SPGI is about halfway through that really big red candle. Remember earlier, we were talking about measure the candle. When you get a really big candle, put a fib on it or put your quant tool on it. See, this doesn't have the extensions. Perfect. All right. So what I did up there, I measured from the high of that big candle to the low of that big candle, plotted out 50%, and then plotted out 100%. Where did it finally stabilize? 100% of the move. Well, now we had another really big candle yesterday. You can mark out 50% of that move. And 100% of that move. Right now we're above the 50% line. I would look for that to provide a little bit of support and maybe a trigger for an opportunity if this sector continues to do good this morning for that run back up. Now that it's above that 50, I don't want to see it come back down below it. So if you're looking for an opportunity, it's very likely going to fade a bit at the open a little bit. But look for the fade, then look for the reversal. Not just in this name. I mean, I don't really care about SPGI in the grand scheme of things. It's going to be the same way in a lot of names. Oh, nice red to green here. Not red to green. Excuse me, just nice. Move to the upside, American Express, inside day breakout. That's what I was trying to spit out. And on American Express, mark that candle. The 50% is very likely going to be where you run into some resistance. All right, so we're at the 75. If we can break through that, which would be an inside day breakout, 159.50 would be a good target. I'm really hesitant to mess with Tesla, the whole thing going on with Twitter and everything else. So, I mean, this could catch a bid and try to reclaim that 310 this week. I don't know. Trading it on the intraday with whatever flow you're getting, great. Trying to predict in advance that this is going to catch a bid today with everything else, I wouldn't want to say. Look at what it did yesterday, right? It was doing its own thing 100%, not doing what the rest of the market was doing. So with this one, trade what you got. I'm definitely keeping my eye on Ford. I've got a couple of short puts in that. I was definitely looking to accumulate some stock. Not this soon, but I mean, that was my ultimate goal anyways. Again, and I've been saying this all year, it's starting to sound like a broken record. It's finance and energy on the intraday. Those have consistently provided opportunity all year. Today's not looking to be any different. Keep in mind, we still got to get out of that range. And in the big picture, once this range is broken, we should make a really good size move. We could grind, right? I don't want to take that off the table. We could grind our way back up. I don't expect it to be that kind of move. All right, so you got your levels. Watch the sectors, see what finally starts to get into play when we do break out. Those sectors will point you in the direction for how strong this move is, and then use the Fed funds tool to make sure that they really are done repricing that Fed pivot. All right, so that's what I got. Y'all be careful, be safe. I will see you tomorrow, and I will get the YouTube video loaded up as soon as Zoom is done rendering.